Hey everyone, this is Robert Keens of Gold Silver Pros. It is Wednesday, May 27th, 2021. I have a returning guest to the program. It is Lior Gantz of Wealth Research Group. How you doing, Lior?
I'm doing well, and thank you for having me back.
Yeah, absolutely. It's been several months since we had you on the show. We've been trying to get you on here for a while. We just had to wait for schedules to clear. So thanks for coming back on.
Absolutely.
And since the last time we talked, there is a lot more to talk about, I think. A lot that's happened in the general economy and also in some of these markets, the crypto markets and the gold markets. So I wanted to get your take on a lot of these things. And I wanted to start off with gold. We recently touched on $1,900 gold here in the US this past week. And I want to get your opinion. Is that the top for gold? Do you think that's going to last a while? Or what is your viewpoint?
I think what happened is in August 2020, the bond yields for the 10-year bottomed for the 39-year bull market in bonds. So in my opinion, the 39-year bull market in bonds, and when we say bull market in bonds, this means lower government bonds. So lower yields, higher prices, ended. And it ended the same day that gold hit that peak of 2069 an ounce. So what happened since then is you saw a big shift in the bond sector, and the bond sector is the biggest market in the world. It's $30 trillion worth, and they were starting to think in terms of, they were trying to price in vaccines. They were trying to price in a change in back then in sentiment towards then President Trump, and towards President Biden, etc. And bond yields started to rally from 0.5. So in other words, 0.5% on the 10-year bond. That was the bottom. It rallied 220% in 6 months. That's unheard of. Just so you understand, people that bought bonds in August 2020 and held them, they lost 50% in 6 months. That's a big move for bonds. And by February, bond investors has priced in so much inflation and so much of this boom. And I will explain why, in my opinion, they did that we saw a huge crash in the tech sector, not in the NASDAQ so much, but in the more speculative side of tech. I can give you dozens of names that were very popular retail stocks that were down 40, 50, 60, 70, 80%. Good companies, not companies that are hyped, but good, fundamentally good companies that just had their price inflated during the past year. So what happened? If we compare like 2020 and 2008, that will give us the best idea. In 2008, it was like a Formula One race where, the car, every once in a while, back in the day, they had to change fuel. They don't do that anymore. They don't pit the cars to put more fuel. They put enough for the whole race, but they have to change tires. And sometimes there are mechanical problems, and they tell the driver to pit, or they tell them to touch the engine and change settings. In 2008, the car was not doing well. The driver was not doing well. He needed to pit, and the driver itself needed a rest. Like, the economy was doing bad. There was too much leverage, bad loans, etc. And so the constructor said, pit. The team told him to pit. You pit, you change tires, etc. That's an analogy for government bailouts, etc. You go on the track again. You got new tires. It takes time to adjust to the new tires. That's a recovery, and then you're off to the races. That's 2008. In 2020, nothing was bad with the car. Nothing was bad with the driver. We had a booming economy. We had a great time for the United States. People were coming into the middle class again. Unemployment was at record lows, but the car was driving like 200 miles an hour, and then there was an official just at the middle of the track that said stop. Held the sign and said stop. There's nothing wrong with the car. The car needed to brake from 200 to 0 and just hold and hold and hold. And while it was holding, the team came in and turbocharged it, which is like stimulus checks, and then the other, another guy put another adjustment in. By the time the sign was like moved and they let the economy run again, man, that car was flying. We didn't have a recovery. We had a boom on our hands. And, when you have a boom, supply chains are constrained and you got inflation in lumber and commodities, wheat and everything. Wages are going up, etc. And the Fed doesn't understand that its reaction to 2008 bailouts and papering over, and this reaction, bailouts, papering over, stimulus, etc., was the same. The problem was not the same though, but because it's a fiat monetary system, the reaction from the people was the same. People sold out of stocks in 2008. They sold out of stocks in 2020. So because the initial reaction from the public was the same in both cases, then the reaction from officials was the same in both cases, but it wasn't the same problem. And that is why I think that the bonds priced in so much inflation. Then about a month ago, we got the CPI numbers and we got a lot of the Fed talking about this being transitory. So now the market is kind of at a point where it's thinking, okay, is the Fed right? Are we right? Who's right? And in the meantime, this inflationary scare is kind of over. The inflationary scare actually did not help gold because so much scare doom about inflation got the bond yields up to a point where yields were going up. And obviously rising yields are not good for gold. So counterintuitively, higher inflation didn't help gold. Lower inflation, in other words, if inflation is going to be higher than usual, but not exploding, that's actually a better scenario for gold. And that's what we're seeing right now. We're seeing right now that the market is thinking mostly there is a transitory aspect to inflation and there is a non-transitory. That's why I think forget about the 2010s, forget about low growth and low inflation. We have a decade upon us that is higher growth, higher inflation, not super high growth and hyperinflation, as a lot of people are afraid of. In the United States, a very robust, developed economy, the only way to see a real out-of-hand inflation is a super change to the monetary system. In other words, if China does something where it says, look, we're not going to manipulate our currency anymore. It's going to be free trading like in the West. We're going to be doing the same standards as you are. Man, about 20 Asian countries will dump dollars and start buying yuans because for them, that will be the new reserve currency. So if there's not a supernova event that's bearish for the dollar, we're probably going to see 2 to 2.5, 2.3, 2.8% on the CPI. I know the CPI is bogus, etc. And I know all of it, but the markets watch the CPI, so that's what I'm talking about. But of course, when you go and shop and whatever, it's understood that you're seeing much higher inflation. Anyways, for gold, I believe the case is clear. Gold is very relevant in today's world. Obviously, cryptocurrencies have taken $2 trillion away from gold and other assets that are like gold. So that has taken away from its steam. And that's why it's not 23 or 24 or 2,500 already. But if you remember, Basel III, April 1st, 2018 or 2019, I'm sorry, gold was $1,281 an ounce, $1,291 an ounce. The day they announced Basel III is the day that central banks acknowledged that gold is worth basically double what they just said. Mm-hmm. Because they gave it a collateral of 100% instead of 50%. So we know the central banks figure that gold is worth around $2,600. And that's why I'm very bullish on gold. And I think that the summer, when we're going to get more CPI numbers out, and we're going to see that the Fed is probably not going to raise rates, not going to tighten, that's where I think we'll see a big breakout for gold. For silver, the case is even more bullish.
So you talked about a lot of things there. I want to talk about the dollar and crypto since you kind of hinted about the crypto complex. I know that a lot of people see the crypto as alternatives to gold. You mentioned that they may be an investment people are putting their money into instead of going into the metals. What about crypto and the dollar? Do you think that people are looking at crypto as natural currency? Are they looking at it as a safety asset class? Is it a competitor to the dollar? Or do you think crypto and the dollar are different animals?
I think cryptocurrencies and fiat currencies, in people's minds, especially young people, they're much more similar than a dollar and gold. When you give someone a bill, like a dollar bill in gold, he doesn't say, oh, very similar. I see all of the similarity. If you're not educated on what money is, the characteristics of money from the Greeks all the way to today, then you have no idea. And so I think for most people, they see cryptocurrency, okay, a medium of exchange. That's easy to understand. It's digital portal. I can, probably in a year or two, I can, use my smartphone and pay for stuff with a code, etc. So, in my opinion, we're not going back to some sort of a gold economy or a gold-based economy, and we don't need to, Robert. That's the whole point. Mm-hmm. For 50 years, we have not been on any sort of gold economy, and look at what has happened to the price of gold. It's gone from $35 an ounce to $2,000. So a 58-fold move. Why would you ever want to back the currency with gold again and let politicians scam that system again? Because that's what happened in the 50s and 60s. They ran the printing presses much more than they mined gold. They couldn't keep that 35-1, but nobody could capitalize on this scenario. Now you can capitalize on that, and you know what? Every person can own gold. So it's not like you have an excuse. You know what I mean? So in my opinion, it doesn't matter in the big picture what's the monetary system. Cryptocurrencies are definitely going to be part of the future, in my opinion. They won't replace fiat currencies. It's not like governments are going to step out of the game of currencies. They're not, especially not in our lifetimes. But certainly, cryptocurrencies are going to have a bigger role. Now, when I say cryptocurrencies, Bitcoin is one. The others, maybe part of the other ones that are more developed, fine. The rest of them are more like tech companies, and you should treat them like that. When you're buying altcoins, you're buying startups. That's what you're buying. You're buying pieces of equity in a company. So you need to do your due diligence on it. Now, the fact that they're unregulated and the whole thing is like a wild, wild west, that what gives it a lot of speculative nature, and you can make epic gains and epic, it's a different ballgame, right? From more regulated parts of the economy. But I don't compare them to gold and silver. There's nothing that could be compared between altcoins and precious metals. And the other thing is, why choose sides? Why choose sides? Well, on our newsletter at Wealth Research, in January 2017, we profiled Bitcoin at $450 an ounce, a coin. In March 2017, we profiled Ethereum at $12 a token. This is 300-fold move since then. Mm-hmm. We didn't say we're bullish on Ethereum at $12 here and we're bearish on gold. We were bullish on both, and both have done well. So in other words, the debate, why debate it? They're different animals, but they're both amazing for what they're doing right now. So that's for me the other thing. The third thing is regarding the dollar. The dollar, if you look at the DXY, which is the index, you can see that it topped in March or April of 2020. It peaked around 130, which was the all-time high. Now, it reached in every all-time high, in every bull market for the dollar, it peaked at 130. It's like the ultimate peak for it. It's when it's so expensive compared to these other currencies that the US is getting uncompetitive at exports and this and that. So globally, there's a move to sell dollars. And that's what we saw. We saw it go from 130 to now 90. And 90 is the big support level, the 5-year support level. If you look at the DXY right now, it's 89. It just reached below the support. That's why you're seeing gold breaking out in recent days, is because there's a clear dollar sell-off. Now, if it goes from 89 to 85, it will confirm it. And if it goes below 85, so in other words, to the 84s, that will trigger a huge trader sell-off. That is a big bear market in the dollar, which is super good, obviously, for commodities, for precious metals, for mining companies, etc. And I think that we're headed that way. We're much more headed down than up for the dollar.
And you mentioned the Fed earlier. You mentioned that you thought that when you start to see a little bit higher inflation in the future, you don't think that they're going to raise rates. You think they're going to be accommodative, in other words. How do you think the Fed has managed in the last year? I mean, we had the pandemic around the world. We had all of the challenges with the shutdown economy. There was a ton of liquidity. You look at an M1 chart for 2020, and they multiplied the M1 currency by a factor of almost 5 in a year. Looking forward at potentially some higher inflation and expanding and some booming economies, what do you think the Fed stance is going to be? Do you think they've handled this well? Do you think going forward, what do you think their approach is going to be?
So I think what the Fed did was basically in March 2020, it saved the system from collapsing altogether because everything was frozen. The credit markets were frozen. In other words, if the Fed had done nothing, you would have seen basically the G7 meeting and saying, our system is done. There's no money at the ATMs. The banks are closed. The doomsday scenario.
Yes.
Now, because it's just the way the system is worked. It works on liquidity, and credit froze. Like there was no lending at all. So if you remember, the Fed over the weekend lowered rates to 0. That did nothing. The markets opened up. There was a circuit breaker every 15 minutes. They didn't care. Like rates 0. I mean, we've heard this before. So it did nothing. And then what really fixed it was that they said, we're going to buy the junk bonds. We're going to get the irony of it is they never bought junk bonds. They just announced it. And because it gave so much faith and trust in the system, it lubricated credit, and it was off to the races from them. But the Fed is doing two things. One, its belief is that we are not seeing hyperinflation. We're seeing supply chain constraints. We're seeing all sorts of imbalances. They're transitory. That's what they agree. That's what they think. Now, in the last 2 months, they've changed their stance and said, no, look, it's not all transitory. Tourism, for example, in order to get people back, you can go to theaters for like $1. So if the theaters raise it from $1 to $2, that's 100% inflation, right? But it's transitory. Even if it goes to $3, it's not like theaters are going to raise prices to $100. Same with airline tickets, etc. So some things look as if they are hyperinflation because we just had an unprecedented 2020. So these are transitory things. What is not transitory? Wages are going up because there's a labor shortage, because there's a skills shortage in the United States, a legitimate skills shortage. And that's not going back. It's not like next year, the company that employs you is going to say, hey, you know what, that wage, that bump that we gave you last year, that salary that we paid you last year, well, it was too much. We paid you that just because we couldn't find other people. So now your wages are going to go down. It's not the way it works. And so salaries are going up. And what most people don't know is like in a loaf of bread that costs like $1.50, the wheat component is 8 cents. About 60 to 70 cents is labor. It's the supply chain going from the field to your supermarket. It involves like dozens of people. So America is built on wages, and if wages are going up, inflation is going to stay with us. The Fed is obviously understanding this, and it's not just wages though, but just to keep it short, what they are seeing is this. There's a transitory component of it. There's a lasting component of it. We're not in the 2010s anymore. This is not low growth, low inflation. We're at higher growth, higher inflation. And so for a decade, we had CPI numbers that were between 1.4 and 1.8%. We never reached our 2.0 target inflation. And therefore, we're going to average it out. and we're going to let inflation run at 2.2, 2.3, 2.4 on the CPI. I stress that again because your viewers are going to be like, okay, it's 6%, 7%, 8%, not the CPI. In real life, sure, you're seeing way higher inflation, but for our call and for what we're talking about, which is assets, and now Wall Street is moving.
CPI is the benchmark that everybody uses, so
exactly
everybody has to use a benchmark. Yeah, right.
Exactly. Okay, and for what we're talking about, like the prices of silver and stocks and bonds, that's what Wall Street. That's how Wall Street moves. So, and that's what they're going to do. They're going to try and average it out. So that's why they're going to keep it hot at 2.2, 2.3, 2.4. And as long as it doesn't get out of hand, they're going to wait as long as they can to average it out from the low inflation years. And that's really good, obviously, for commodities, very bad for the dollar. It's going to keep us in a negative rates environment for a long time. And man, you're seeing the benefits of it for commodity investors. But, people thinking this is going to crash tech and et cetera. 2.5% inflation is not going to crash innovation. You need way, way higher interest rates in order to, I'll give you the best example. If you're organizing a concert and you booked Rihanna for your concert and the whole thing's packed, it's sold out, you're going to make a killing. 2 days before the show, you realize you're short on mics and microphones and all sorts of sound equipment, and it's going to cost you like $1 million to buy all of it. What are you going to? And you're going to make 6-7 million on this show, and the bank tells you, well, we'll loan you that $1 million, a bridge loan. We'll give you like 4 days. You'll buy the equipment, you'll sell it secondhand, you'll pay us back, etc. So you're going to make millions in the meantime. Are you going to say, no, I'm going to make 7 million. I'm not going to borrow $1 million because it's 3% or 4%. It doesn't matter. And that's how tech CEOs think. They're thinking about things that will change the world. And their companies are growing 15, 20%. It's not going to stop innovation. And you don't have to worry about interest rates at 2% or 2.5%. Now, if they go to 4 and 5, it's a different world. But I just don't think people understand how impossible that is. The United States government is paying 1.6% on the 10-year bond. It's the highest in the world. If you go to Germany, you're not going to get any interest rates. And then you have to go, lower to like Greece and Turkey, Spain to get yield. And they pay less than Washington. So the best of the best economy is paying the highest yield. And that's why there's no incentive for the United States government to pay more than it pays. It's already spending $1.5 billion a day in interest payments. So it's not like it's nothing. It's already a lot. So the competitive nature between these governments is already, America's winning already. And so interest rates are not going up. I think they're going to stay very low for a long time. And so if inflation is going up, very good for commodities, very bad for the dollar, but not as bad as people think for tech. In fact, for example, if you go to Wealth Research Group, to our website, if you look at the top menu, there's a tab that's called Watch Lists. And those reports are my personal portfolio. Since April 2020, I've released about 8 reports, and they comprise my entire portfolio. And you can see a lot of them are tech. And man, you can see that in the past 2-3 weeks, some of them are up already 50% tech. And so it's not like it's the end of the world. Yeah, those exactly right. In fact, you look at that one that's called TechRec 2021. That's made out of 7 companies, actually 6, because we just did an alert. And we sold one today after it was up like 20% in the past 2 weeks. But if you download these companies, you'll see it's a whole array of them that make up the portfolio. And each one of them, Robert, has a limit, like my personal limits where I like to get into these. But the idea here is that you don't have to be scared. It's not like we're not going into a world of 1970s style inflation, in my opinion.
Gotcha. So what other picks do you have for the viewers? What are you into? What are you looking at for the rest of 2021?
So in terms of like mining stocks and commodities, or
mining stocks, commodities, whatever sectors you want to talk about. What do you think is going to do the best for the rest of the year?
So my mindset, since I started investing age 16, when my parents were waltzed into a bank branch to sign a waiver.
Mm-hmm.
So a miner can trade at that time it was mutual funds.
Mm-hmm.
But anyways, my mindset has always been, what is the best relative value? Because there's nothing that's an absolute bargain. Mm-hmm. There's things that are bargains compared to other things. And when I look at the world right now, and I think to myself, okay, what is relatively valuable? What is inexpensive? So for one, I see silver trading in a range between 29.5 and 22.5 for months, almost going on a year right now. So it's a very nice range where you see clear resistance and clear support. Mm-hmm. So to me, if silver breaks above that resistance at 29.5, it's going to shoot up to about 36 in no time. Okay, so I'm very bullish on silver once it hits 29.5. If you can share a screen and show the DXY, for example, the dollar index, we can see that if it's below 90, you're looking for that confirmation that it goes a little lower to 88, 87. That's going to be a big breakout in commodities. So look for those. We're literally within days or weeks away from a huge breakout. 89.99. What? It couldn't be more dramatic for this interview.
Right.
It's like literally, it's like the Bulls and the Bears are literally fighting over this. There you go.
There it goes. It's 90.
The Bulls
down 0.05 for the day.
Yes. This is, if you plot, you're plotting a 6 month. If you plot like a 5 year,
yeah,
the audience will clearly see how. Yeah, you see that between 2015 and today. If you plot that line right at the 90 level,
that's right.
At the bottom part of it, you'll see exactly that's the support, and it's right on the exactly. That's it. Mm-hmm. That's the support right at that 90 level. And if it breaks down, it goes all the way down to that 2014 breakout. Mm-hmm. We saw that 75 level. That's the all-time low.
Right down here.
Yes, that's a big move. That's a multi-year move. And if we go on that one, I will be very, very bullish on mining stocks. And I believe, if you look at mining stocks, just remember, they're not buying holds. This is not buying shares of American Express and forgetting about them until you're in retirement. These are vehicles that you trade. You get in, you get out. You're basically looking going from depressed to fully valued, and you're out. Because if you plot like a Barrick or like a Newmont over 30 years, you'll see that they're like an EKG. They don't break down. They're you just look for the right times to get in and get out. It's a business cycle. It's a cyclical stock. So that's one thing I'm looking at. Again, if you on our website, if you download these watches, you'll see that you'll see the companies that I really like. I like cyber companies because cyber is becoming a really important part of today's world.
Yeah, and I agree with that because I have a master's in cyber, so 100% on board. Just to interrupt you for a moment, there is a shortage of 1 million jobs in cyber in the United States alone.
There you go.
Huge.
And and that, for example, in that TechRec report, there's one company that's the biggest cybersecurity company in the world, and it actually hasn't done anything for like a year and a half. Its share price is stagnant. So I'm a big shareholder in that one, for example. I like companies that are in the online shopping. I don't think that is going back to people. Obviously, going back to brick and mortar. They love to roam the malls, but there are a lot of things that people are willing to do online, and I don't think that's changing. So I like that a lot, and I like companies that have a big competitive advantage on the back end of helping the FANGs. So companies that are indispensable to Apple. They're not. You won't know their names because they're not retail. They're
suppliers, you mean?
Yes.
In the supply
Yes.
chain.
Exactly. Either in the supply chain or in the back end for all of the server farms, all the things that Apple needs, and these are companies that can't be replaced. Facebook doesn't shop for competitors for it because it has all of its computers on that particular software. It's hard to move them. These are very important companies. They're under the radar because people just don't do the research to find out about them. They're also in these reports. You'll see a bunch of them there. So I like that component of it as well. In terms of like buy and holds or dividend companies, etc., I think a lot of boomers are chasing yield, and it's hard to create that 6% or 8% portfolio that is just it's 6 to 8% a year, doesn't go up or down, no volatility. Very hard to create that, and because people are chasing yields and whatnot, they're buying into companies that have a juicy dividend and no way to sustain it, or that the company's business fundamentals are on the decline. And I think those are traps. So mind those and differentiate between those and companies that actually have great dividends, and the dividend itself doesn't have to be high. So they did a study back all the way to the 70s, and they looked at what are the best performing dividend companies. And they saw that the best performers are companies that have a dividend between 3 and 4%. So companies that have like 5, 6, 7, 8, they didn't perform as well as the ones with 3 or 4%. And they looked at the ones that pay 1% or 2%, and they saw that within that category, there are companies that are growing their dividends very fast, and they're going to be 3 and 4% in a few years. And they saw those are the ultimate companies. So those are companies that I follow really closely, and we cover them on the newsletter as well. So those can be companies that pay 1% today, but in 3 years they're going to pay like 3%. And what happens is it's like buying a home for $100,000. The renter is paying you $1,000 a month right now, but he's telling you, you know what? I know it's only $1,000. Keep me on, and in 3 years it's going to be $3,000. And I'm going to keep that rate going, and it's going to continue. So you're giving up a little bit of the yield on the front end, but you're going to get so much more on the back. On the back end, you're going to get so much more on the front. So
that means, Lior, for people who haven't done dividend stocks before, when you get a lower yield, you get a cheaper price. You get in a lower base. When that yield goes up, the value of that stock goes up. So not only getting the higher yield, but people will pay more for that. So your original principal has gone up as well. Absolutely. Those are there's a group of companies called Dividend Champions. You can Google it and download the whole list. It will be like 350 companies. There's a list that's called Dividend Aristocrats, and those are companies that have been able to grow their dividends every year for 25 years or more. So think of the world 25 years ago. These are really competitive companies. They've been able to deal with a lot of changes, many presidents, many interest rates. Okay, the Dividend Champions did the same thing, but for 10 years. So the sweet spot is to find those dividend champions that are going to be dividend aristocrats, and those are those companies that are 1 or 2% now, but are going to be at 3 and 4% later on. So I like to follow these and also to cover them in the newsletter as well. So those are the things that I primarily look at, and I'm so bullish on real estate. It's not even funny. I've never been as bullish on real estate as I am today, and I can share with you why, etc. But I'm super bullish on real estate in America. I'm assuming it may have something to do with interest rates, but also what else would be your reasons? So interest rates, obviously. Inventory is the lowest ever. Yeah. Ever. Now, couple that with the fact that there's 150 million people in the United States that are employed. So that's the workforce. 33% of them are millennials right now. So 50 million. By the time this decade ends, it's going to be 75% or about 120 million. So the taxpayers are going to be millennials.
The politicians are going to be looking to help millennials. You can already see that. What is child tax credits? That's helping families. It's not, Medicare, Medicaid, Social Security. That's bribing boomers for votes. Now it's going to be about millennials, because they are going to be about 90 million people. So the biggest generation demographically. Yep. They're going to be taxpayers, and you know what they don't have? They don't have homes. They're either renting or living at home in general. And so there's so much more construction that's going to happen throughout the United States. Because of work from home, people are going to be looking to build houses. They don't care about living in the middle of the heart of the city. They have to go to work just 2 times a week for, sessions in the office or something. There's a lot of hybrid models that are happening. I mean, Robert, the fundamentals are amazing. And people, all they have in their heads is 2008 and the trauma. But I don't think they understand. Millennials don't have that trauma that much. They're willing to sign a mortgage. They're willing to go into debt. And they understand that 30 years fixed at about 3.5%, that's like taking money for free. It's like the government telling you, oh, we'll pay for 90% of your home. You just put in the first 10. So it's I'm very bullish on real estate.
So if people want to get access to your research, we showed the webpage where you can go to Wealth Research Group, go to the newsletter section, put in their email. What are your last thoughts before we wrap up this interview that you want to leave with the viewers?
Okay, so I think the most important thing is to understand that the mega bear event has already happened. That 35% moved down in 16 days, March 2020. About that, Robert, for a second. That was the worst panic we've ever seen, ever in our generation. If you go back to the news, it was people were dropping dead in the street. You remember that? In China, like, this is the end of the world. 35%. So just think about that. 35% was the worst of the worst. That is the downside for the stock market. The upside, much, much higher for stocks over time, much higher than 35%, much higher. So I think people, the worst mistake they make is they leave residue from traumatic events in their lives, and they live that trauma the rest of their life. So they will, I don't want to ever touch the markets. It's a casino. I don't want to ever buy a house. I lost one in 2000. Don't do that. Everything is moving forward. Equities are going up. The people are making, the economy is growing. Get involved. Get into, use your skills, use your talent. Do not be afraid, because we're moving forward. This is a boom. The Formula car is running, and it's on the track. So I think just that word of encouragement, leave the scarcity and the fear mentality home. There are problems. Of course, there are problems. It's not like I'm leveraging and taking on, debt. I own 2 years worth of my living expenses in gold. So that's way more than most people do, right? If you take, if you think about the burn unit, the burn rate of a family, the cash rate for 1 month, think like hypothetically $5,000, multiply that by 24, that's $120,000 in fiat currency, convert to gold, that's 2 years. It's way more than most people have, just hypothetically. But the idea here is that don't give up safety, but don't give up upside as well. That's my message.
Yeah, just balance it out. Balance out your portfolio with some gold, speculate a little bit on silver, but look for other opportunities as well.
Absolutely.
All right, Lior, so good to have you on the program. We'll have you back again as well. Appreciate you very much, and thanks for stopping by.
Thank you very much.